The Consumer Price Index, or CPI, report just dropped. And if you care about your money, and I know you do, you need to pay attention to what it says. Now, most people hear inflation data and tune out thinking it's just another headline. But the truth is, this report is like a financial weather forecast. It tells us where the economy is heading, whether your paycheck will stretch further or shrink, and even what direction interest rates might take. So let's break this down. The CPI measures the cost of a basket of goods and services, things you buy every single day like food, gas, housing, medical care. When the report shows prices are rising, that means inflation is eating into your wallet. When it shows prices leveling off, it means the pressure on your spending is finally easing. That's why investors, investment, the Federal Reserve, and even your landlord are watching this report so closely. It sets the tone for everything from mortgage rates to stock prices. Now, looking at the latest numbers, the key is whether inflation is cooling down or staying stubborn. If it's trending lower, that's a good sign interest rates might eventually fall. Borrowing gets cheaper and the cost of living stabilizes investment. But if it's still hot, expect the Fed to keep rates higher for longer, which means credit card debt, mortgages, and business loans all stay expensive. In other words, the CPI isn't just data. It's a reflection of how hard or easy your financial life is going to be in the near future. But what does this mean for your day-to-day money? Think of it like this. Higher inflation means the 100 in your pocket today might only buy 95 worth of stuff next year. Groceries cost more, rent climbs, and suddenly your savings account doesn't stretch like it used to. Inflation also eats into investments if your returns don't outpace rising prices. That's why understanding CPI isn't optional, it's survival. So what should you do? First, cut back on high interest debt. Credit cards become more dangerous when rates are high. Second, look for safe places to park your money, like high-yield savings accounts or treasury bonds, which often rise when inflation does. Third, diversify your investments, stocks, real estate, maybe even index funds, so you're not relying on one income stream while prices rise. And finally, stay disciplined. Don't panic with every CPI release, but do adjust your strategy when the numbers tell you the economic climate is shifting. At the end of the day, investment. The CPI report isn't just some government statistic. It's a snapshot of how your money is performing against the rising tide of inflation. Pay attention to it, plan around it. Investment, you'll be far ahead of most people who ignore it until it's too late. The Consumer Price Index, or CPI, is one of those terms that sounds technical, but actually affects you every single day. At its core, the CPI measures the average change in prices of a basket of goods and services that households typically buy. Think groceries, gas, rent, medical care, clothing, and even entertainment. When economists or the news talk about inflation, they're usually talking about the numbers that come straight from this report. The reason it matters is simple. If the CPI shows prices rising, it means your cost of living is going up and the money in your pocket doesn't stretch as far as it did before. If the CPI shows prices cooling down, it signals relief. Your paycheck holds more value. It also acts as a guide for the Federal Reserve to decide whether to raise or lower interest rates, which then trickles down to your mortgage, credit cards, and loans. In short, the CPI is like a thermometer for the economy. It tells you if things are heating up, cooling off, or stuck in between. Understanding it means you're not blindsided by rising costs, investment, but instead prepared to adjust your financial decisions before they impact you directly. The latest CPI report doesn't just throw out random numbers. It tells a story about where inflation is heading. Makes a good investment. When analysts break it down, they look at two key parts: the headline number, which includes everything like food and energy, and the core number, which strips those out since they're more volatile. If the headline CPI shows a big jump, it usually means energy prices spiked or food costs surged, both of which hit consumers immediately. But the core CPI is what really matters for long-term trends, because it shows whether inflation is embedded in the economy or just reacting to short-term shocks. If both numbers are trending lower, that signals inflation is easing. Investment, and eventually the Federal Reserve may consider lowering interest rates. That could mean cheaper borrowing and a little breathing room for households. On the flip side, if the CPI shows inflation staying high, or worse, climbing again, it signals that the Fed will keep interest rates elevated for longer, making credit card debt and mortgages more expensive. So the report isn't just about data. It's about direction, investment. It reveals whether we're moving towards stability or bracing for more financial pressure in the months ahead. Investment. Inflation isn't just a number in a government report. It shows up in your daily life in ways you can't ignore. When the CPI climbs higher, it means your grocery bill gets bigger even though you're buying the same items. Gas prices creep up, making your commute more expensive. Rent increases, leaving less room in your budget for savings or extras. Even something as simple as going out to eat or catching a movie starts to feel heavier on your wallet. Beyond day-to-day spending, inflation directly influences interest rates. Investment. Higher inflation pushes the Federal Reserve to keep rates high, which means borrowing money becomes costlier. That mortgage you were considering, suddenly the monthly payment looks a lot steeper. Credit card balances. They grow faster because interest rates climb along with inflation. And if you're saving money in a regular account, investment, the value of those savings quietly erodes because the return you're earning doesn't keep up with rising prices. Inflation is essentially invisible. It doesn't announce itself, but it constantly chips away at your purchasing power. That's why watching CPI matters so much. It's not just abstract economics. It's a preview of how much further your money will or won't take you in the months ahead. When inflation shows up in the CPI report, you can't control the numbers, but you can control how you respond. The first step is protecting yourself from high interest debt. Credit cards and personal loans get more expensive when rates are high, so paying them down quickly is one of the smartest moves you can make. Next, think about where your money is sitting. If it's in a regular savings account earning almost nothing, inflation is eating away at it. Instead, move it to a high yield savings account or short-term treasury bills, which usually adjust faster to rising rates and give you better returns. On the investment side, diversification becomes your shield. Stocks, real estate, and index funds historically outpace inflation over time. But you don't want all your money in one place. Spreading it out reduces risk and improves your chances of keeping ahead of rising costs. And finally, focus on cash flow. Building multiple income streams, whether it's a side hustle, freelancing, or investing in dividend-paying assets, gives you a cushion when prices climb. The CPI is a reminder that inflation will always be part of the economy, but with the right strategy, your money can keep working harder than rising prices.